together some online courses at the moment. So these are coming soon for IF1. So I just wanted to kind of give you a bit of a sneak preview if it works. There's going to be a little bit of a voiceover that you can hear in the background. But essentially all of the key fundamental concepts of IF1 are going to be within this kind of online course, just so you have a look at what it looks like. We're both quite excited about it, so hopefully we'll be able to give you some more news on that soon. So the way that we're going to run today's session, I'm just going to pause out of this and kind of come back to my slides, if I can. There we go. So I'm going to run today's session. It's very ambitious, trying to squeeze this book into 60 minutes. It's going to be pretty intense, so I'd say get your pens at the ready, and maybe try and use this kind of 60 minutes just to take everything in, and then hopefully, because it's Friday afternoon, you won't have to do much else after in your work. Essentially, I find that this book is probably the worst for all CII books. It's just got so much content in it, 11 chapters, it's the biggest, it's the chunkiest. You've also got obviously 100 questions, and it's a 2-hour exam, so it really is the worst in terms of getting it under your belt. So once you do, then we can, obviously it will be plain sailing from there on in. And so a couple of things I want to flag before we get going. Essentially, we are going to look at quite a lot of detail in the principle of good faith, because that's got about 11 questions attached to it. And then the main features of the London market has got about 14, and then regulatory and legal has got 15 questions attached to it. So they're quite chunky areas. What I've tried to do, obviously, I'm not going to be able to cover the whole book in 60 minutes, but I'm going to be able to try and pull out parts. So hopefully, if you've got your exam coming up, you'll be in a good position to essentially get that to the forefront of your memory. So there's a couple of revision aids that we do have on a website, and the IF1 isn't on that particular picture, but we do have it available. So let us know if you need any help on that basis, if you want some extra kind of resources to do some practice questions. So the first thing we're going to look at is overview of risk. And then we're going to look at some of the key principles that you need to know from an insurance perspective. So there are quite a few in the book, but we're going to go for the key kind of ones that come out the most. Then we're going to look at the key roles in insurance, and also kind of give you a general structure of the market and how the different parties kind of liaise with each other. And then finally, we've got some bits and pieces on legislation and regulations that I think you need to know. And then also we have at the end what I lovingly refer to as extra stuff that I think don't really fit into those headings, but you kind of need to know. So we'll hit those in the last kind of 5 minutes of this session. So if you do have any questions throughout the time, if you just want to write them in the chat, you're more than welcome to. But otherwise, I'm going to crack on, and I'll kind of go through, and I'll take some pauses just if you want to write some things down. So let's get going. So here we go. First of all, let's just do this overview of risk. So this whole chapter at the beginning really sets the scene for what you need to know. When Sam and I did this exam, it was referred to as the Lloyd's test. So it was quite a few years ago now, but it used to be a big back binder, and it used to have at the beginning, insurance is a risk transfer mechanism. And I remember opening that up and thinking, oh God, what have I let myself into? But essentially that is the best way to describe insurance. We're taking the risk and the premiums of many, collecting them in what we refer to as the common pool. And then hopefully that common pool will just pay out for the very few unfortunate people who do suffer a loss. So that is what we refer to as our risk transfer mechanism. We're trying to get peace of mind. So as individuals, as companies, we want to make sure that we've got some form of backup if something should go wrong in our day-to-day lives. So we've got that financial security to make sure that insurers can maybe step in some capacity. So first and foremost, we're going to look at the components and the categories of risk. I'll talk a little bit about pooling of risk at the end, and then we'll move on to risk management. So components of risk, there are 3 altogether. I'll just get you to write these headings down if you're making lots of notes, and then we'll go into each one individually. So the first kind of 3 components that we're going to look at is uncertainty, level of risk, and finally, we're going to look at a peril and a hazard. So they kind of come together as a pair. So first and foremost, uncertainty. We're all exposed to risks every day. So Lots of us weren't going out in lockdown for obvious reasons, so there were fewer kind of road traffic accidents and things like that on the roads. However, you also got lots of a rise in kind of house fires, and maybe, you know, you could also still get the risk of your carbon monoxide alarm going off or something like that. So it doesn't matter whether we're outside, inside, we're still exposed to this risk, and it's always uncertain. We don't know what's going to happen, when something's going to happen, and even if it's going to happen. So that's where insurance will come in and play a really big role. We also have what is referred to as the level of risk, and this is our second kind of key heading or our component of risk. So we divide these down into what is called frequency and severity. So frequency, how often is a risk going to happen? And severity, how severe will it be when it does? So if you have, for example, a coffee shop, and the risk is people slipping and tripping in a coffee shop, all of those will be quite high frequency, they'll happen quite a lot, but hopefully, unless someone dislodges a hip, you'll have quite low severity. So they'll maybe have a couple of bruises, but ultimately it won't be that severe. If you flip that on its head and we turn that around to having something that's very high severity, but maybe doesn't happen an awful lot, so it's low frequency, that could be, for example, an aircraft crash or something along those lines. So apart from, I think, 2016, where we had about 3 go down in the space of a few months, which got me a very cheap flight back from Australia on Malaysian Airlines. But essentially, when we had lots of things going down then, but ultimately it doesn't happen a great deal. So they are quite low frequency, but when they happen, they're massive. You've got, you know, passengers, property damage, you know, third-party damage, lots of other aspects come into play. Just to mention before we move on to our final component, it's worth mentioning that the book might refer to something that's high frequency and high severity. And the best example really for this is something that happens on a regular occasion. So we know every year is hurricane season, so that's September and October. And when we have hurricane season, we're kind of all braced for it. However, you'll know from the news that there's a couple of hurricanes currently happening on the Gulf of Mexico that look to kind of collide with each other at this time. And so we haven't even got into September yet. So we're tending to see probably at least 1, if not kind of 3, 4 hurricanes per season. So on that basis, they're very high frequency, they happen on a regular basis, and obviously their effects are devastating, so it's quite high severity. And then very finally, let's just have a quick think about peril and hazard. And I'll pause after this one if any of you want to take notes. But essentially, a peril, I always think of it as the primary cause of the loss. And it is essentially whereby it's something that gives rise to the loss. So a peril could be a flood or a fire or theft. All of these things can come into play. Whereas a hazard is slightly different because it's how the peril is actually influenced. So for example, if you have a brick house, maybe a fire won't spread as quickly as it would if, for example, you had a house with a thatched roof. So you can have physical hazards, which could be good or poor, depending on how they work. But you can also have what we refer to as moral hazards. And these are the hardest ones to detect, primarily because essentially when you're thinking about them, you're thinking about the characteristics and behaviours of the insured. And how often do insurers actually meet their insured? Very rarely. So you'll look at their past history, you'll look at any claims that they've made, you'll look at any criminal convictions that they have. All of these factor into the moral hazard. Okay. Equally, if anyone wants me to repeat anything, because obviously we go at quite a pace here, do just stick it in the chat and I'll make sure that I get to that if you want to complete your notes at the end. So next up, we have categories of risk. So in the book, these are laid out and there are 6 of them altogether. 3 of them are insurable risks and 3 of them are uninsurable risks. So we're going to go through each pairing as to complete each one. The first pairing I want to talk about is that of financial and non-financial. So a financial risk is insurable because everything that we insure has to have some kind of financial value attached to it. So my phone is worth a certain amount of money, my laptop, whatever else it might be. it has some kind of financial value, and if it were to go missing, I would suffer on that basis of that loss. Something that is non-financial is a little bit harder to gauge. But to give you an example, I used to be a claims adjuster, so that was my background. I used to deal with a lot of liability cases, and this always kind of pinpoints, it's a very horrible case, but it always pinpoints in my mind this concept of non-financial risk. A little boy was playing in a swimming pool in Mallorca, and he was mucking about, and he managed to get his arm trapped in the filter, and unfortunately he drowned when he was in the pool. His family were nearby, they were in the vicinity, but they didn't see it happen, but another family was poolside and did see the whole event unfold. So when we got the hotel, because we were the insurers for the hotel at the time, we got a claim through basically saying this never should have been able to happen in a swimming pool. And they were liable on the face of it because of what had happened. At the same time, I received a claim from the family that were poolside for loss of enjoyment of their holiday. Now, something like that, loss of enjoyment or something, is deemed to be non-financial. You cannot put a value, a price on anything like that. So therefore, that is uninsurable. You can't insure anything along those lines. I'll move on to the second pairing in our categories. So the insurable aspect is what we call pure risks, and the uninsurable aspect is what we call speculative. So let me just give you an example of both of these. So a pure risk is one that we essentially cannot make profit from. So we, as an individual, if we suffer a loss, insurance doesn't let us make a profit from it because of what we call indemnity. We'll talk about that in a second. But essentially, we have what we call a pure risk, which is where we're either breaking even, or chances are, even if the insurer pays us all the money that we're owed, we'll also still be losing a little bit because we'll have had to pay an excess for that particular loss. So that is a key thing to think about there. Its counterpart, or its opposite if you like, is something that's uninsurable, which is speculative risk. And this is akin to gambling. So an example I use is if I were to start up a business and then I insure against the business failing in maybe 5 years' time, it would give me no incentive to make the business a success because I'm thinking, oh, okay, well, insurers are going to pay out anyway, so I might as well just kind of ride this out as I can. You see, that's speculative because I'm looking to stand to gain regardless of what I'm doing. So that particular type of risk is typically uninsurable. The final category I just want to flag is what we call particular, and then its counterpart is fundamental. So a particular risk is something that is localized in its cause or effect. So if you think about a kind of a development plot of houses, and a house catches on fire in house number one, and then we're trying to work out as an underwriter, what's the worst possible case scenario? Is it able to catch alight the other 14 houses on that plot? Because it's a localized risk, so therefore it is particular. And then in terms of its uninsurable pairing, we have something called fundamental. And fundamental is essentially risks like earthquake, war, famine, terrorism, all of these things that are simply too vast on too big a scale for insurers to actually put a price on. So in terms of that, just a caveat that I would say, some of you might be doing terrorism insurance cover, and there is a possibility of getting that in the market, but it's severely capped. And generally, insurers will look at it as a fundamental and too vast to actually write accurately. So technically, it will be uninsurable unless it's got specific cover somewhere for it. Very finally on this slide, before we move on, let's just talk a little bit about the pooling of risk. So we talked about our common pool at the beginning. So all of the premiums that represent different exposures or different risks that we have come into that pool. We have something called the law of large numbers. And this basically means the more data we have on something, the better. So it allows us to accurately price a particular risk. And then we also have what we call homogeneous exposures. And what we mean by that is we can group together kind of similar risks and again, kind of spot trends throughout that. So if we're dealing with that property, for example, that property fire spreading, we're looking at kind of, what are those properties worth? what's the average, what's the fire damage that's likely to happen. And so we're trying to create some kind of trend in that. Okay, we'll move on now to risk management. So now we're looking at how companies go about minimizing or mitigating their loss, or their losses that are kind of coming. So we look at this as risk management. Lots of companies are developing schemes for risk management teams, and sometimes they have their own risk manager if they're big enough as well. But what will happen, imagine a building site, or sometimes I've got a friend who does this in theatre, or did pre-COVID, where she'd go into theatre, she'd put a hard hat on, she'd say, right, that trapdoor doesn't work, that rope is hanging loose, and she'd manage and identify those risks. She'd analyse those, so she'd write them down on her clipboard, she'd scale them maybe from 1 to 5, 5 being the most severe, and then she'd try and encourage or try to recommend controls and implement those controls.